Hello, folks. I see some of you have jumped on board. This is Peter Lemieux with the Insurance Exam Queen. I'm going to be spending some time morning for me. It might be afternoon for some of you, um, discussing medical plans and the most common ones that show up on your test. So it'll take me a little while, but I use slides to help me stay on course. This is not an in-depth teaching, okay? We've got in-depth classes recorded. I have some, Melissa has some where we go into much deeper, more trivial things that can show up on your test. This is kind of a flyby, but it's not that brief. In other words, I want to cover the most important things. So I want to welcome you to the class. And I look forward to doing this. I am going to kind of wait a few minutes because we're supposed to start at the top of the hour, and my handy dandy accurate iPhone clock says I have 4 minutes to go. Um, Unfortunately, in these live classes, you are not able to talk to me, but I do want you to communicate. Juliana already went on and said hi. I do try my best to keep up with your comments on the chat box. And if you have questions or you want to call me out on something, just have at it. Um, I'm not infallible. I have sometimes said things that the connection between the brain and the mouth is not always accurate. So if I say something that's confusing or may even be inaccurate, please challenge me. I hope not to do that, but anyways, we'll work on that. The big overview is we want to cover in this section on medical plans what are the most important things that show up on almost all the tests on regular basis. And I'll try to explain them. So if you're at all confused about them, to clarify them. Sometimes you might say, you don't need all the explanations because you've got it. But just hang with me. We'll move through this and hopefully get to some items that can help you out. Um, just appreciate. I got to change to my computer glasses. Just appreciate that when we teach these classes, there's all kinds of different students listening in. There are people who are really well prepared and ready to take the test, and they're just checking in to see if they understand stuff clearly. There are others who are just starting out and maybe haven't even read the chapter yet. And then there's others who've read the chapter but are confused about some issues. I can't address any one group specifically, so I drive the car down the middle of the road. So for you that are really well prepared, you might find this, he's telling me stuff I already know. For those of you that have not done any reading, there may be some things that come up and you'll say, oh, I'm not even sure what he's talking about yet. But I'm going to try to drive down the middle so I can provide something for everyone. As for my introduction, I've been in the insurance business for 52 years, but who's counting? Um, about the last 15 years or so, I've been helping people pass state exams. That's where I met Melissa Dillon, the insurance exam queen. When she started her own business, I said, Melissa, if I can help you in any way, I will be happy to do so. So how I'm helping her today is by conducting this live class on medical plans. How important is medical plans on your test? I don't know. Every state emphasizes different chapters more. Some states, this is a as much as 10 to 20% of the test. Most states, it's at least 10%. But medical plans and health provisions, basics, those things are really the meat and potatoes of the health insurance part of your exam. So this is an important chapter, and I'm looking forward to doing that with you. And I'll try to keep it as unboring. How do you like that for a word? As unboring as possible, if we can do that. So let us get started now on medical plans. I use slides to keep me straight so I won't wander in the woods and tell war stories and things like that that aren't helpful to you. First, we start with a commercial. I am Peter Lemieux, and I have videos or recordings that you can access really inexpensively. The process is this. You go on YouTube, go on Insurance Exam Queen, and you will see two buttons, subscribe and join. If you click on the join button, you will see that you can get all 16 classes that I have taught, and they're in detail, on life and health for $25 or $26. That's incredible. I advertise this by saying that is the best deal since we invented cotton candy. Okay. But if you think my teaching makes sense and you want access to these videos, you don't have to watch all of them. You pick out the ones that you need the most help on. They're yours for a month. And then if you haven't passed the test in a month and you want to keep it up, you can pay for another month. But you have access to all of the classes for a very, very low price by following that example. That's my commercial. I'm sticking to it. All right, let's get going. When we start off with medical insurance, there's a basic medical policy. Now, basic medical policy, my friends, is not the major medical or comprehensive policy you might be familiar with for your own insurance. That insurance card that you carry is for your medical insurance. It's not technically health insurance, because health insurance is everything we study in the chapter in the course. But medical insurance has a specific, it covers medical bills. Now, basic medical is not a very good policy for you. Don't want to have this for your coverage because it is very limited. It only covers certain items and it only covers them for a certain amount. For example, I will sell basic medical policies as a supplement for major medical, maybe to help you with your deductible or something like that. Limited policy only covers certain perils. It doesn't cover all accidents and all sicknesses. They pay out in relatively small amounts. So if you have a big bill, you could be stuck with a large part of the bill. And it costs very, very inexpensive. It's not much to buy these policies. Now, medical policies come in different shapes and sizes. The highlights of the basic medical policy is there's no deductible. They'll start paying right away, but they only pay a certain amount and they only cover certain perils. So, for example, a very popular limited policy today is a cancer policy. Doesn't cost a lot of money. And if you get cancer, you're going to get some money to help you out. However, if you get anything other than cancer, it pays nothing. If you have a heart attack or you need knee surgery or something like that, that's what we mean. It's limited in the perils. Now, here's an example of a limited policy that seems to show up on a lot of tests. A, D, and D, accidental death and dismemberment. And there's two words that you've got to have clear in your mind when you take the test. The difference between the principal sum and the capital sum. The principal sum is what's paid as a death benefit. The capital sum is a dismemberment benefit. That would be the loss of one limb. If you are unfortunate enough to lose two limbs, you actually get the principal sum. So the principal sum is death benefit or loss of two limbs. Principal sum is always a higher amount than the capital sum. And so you got to understand the difference between principal sum and capital sum. These are like, they show up on every test, okay? How much are we talking about, Peter? A point? Hey, people fail with 69, 1 point. If you know it's going to be on the test, it's not that hard to learn. Don't go into the test not knowing it, right? So principal sum and capital sum on the accidental death and dismemberment policy. Here are examples of basic medical plans which are limited. you may see them on your test. A dread disease policy covers one disease. The most popular of those today is cancer policy. People have bought cancer policies from me, even though they got major medical insurance, but they know if somebody gets cancer, there's a whole bunch of extra expenses that really can burden a family because maybe their mother had cancer. There's something in there, and they say, I want to have the cancer policy. It doesn't cost very much, but you can buy a dread disease policy, which covers one disease. Now, a critical illness policy is like dread disease on steroids, where the insurance company will cover a few diseases. For example, I have a policy in my quiver of policies I can sell that covers cancer, heart attacks, and strokes. So obviously, it'd be more expensive than the cancer policy, but remember, it only covers those three. So if you get diabetes or something else happens to you, just remember a limited policy is like a laser beam. It only covers certain perils. In-hospital expense is exactly what it says. It will pay you if you are admitted to a hospital. So it's not going to pay you for doctor visits, x-rays, outpatient surgery, don't get anything, emergency room, you don't get anything. You have to be admitted in a bed in hospital, and then they will pay you so many dollars a day. And you buy the dollars, okay? Usually not very high. Like you might buy $2,000 a day. That's not going to cover a hospital, but it might help you with your deductible. And if you're in there 3 days, you get $6,000. Okay. Again, not expensive, but it's very limited in the um, what's covered and how much they pay. You can buy a policy that only covers dental, a policy that only covers vision. You can get a policy that only covers prescriptions. And our favorite, which we put a whole slide out on, accidental death and dismemberment. These would all be basic limited policies. Let's go to the source of our affection and love, right? Major medical is also called a comprehensive policy. It's going to cover all perils, sickness and accident perils, unless it's excluded. What would be excluded? If you're committing a crime or you're doing experimental surgery or there's things that you probably wouldn't expect them to cover and that in fact they're excluded. But comprehensive policies cover accident and sickness. A lot of things covered. Okay. However, to get this wonderful policy, you have to pay some of the bill. We call it cost sharing. It's the first thing on the slide. These policies all come with deductibles. You must pay the deductible first. After you've met your deductible, the insurance company rarely pays 100% going forward. After the deductible, you do co-insurance. The most common co-insurance is 80/20, which means you pay 20%. The insurance company pays 80%. So you have to pay the deductible and co-insurance as a cost sharing in this policy. Now, it's comprehensive, it covers all perils. And here is why we want our clients and ourselves to have these policies. It has really high limits. You know, if you owe $8,000, $9,000, that's a burden, but you can pay that off in time. If you owe $200,000, now we're talking about bankruptcy or loss of your house. What's nice about the major medical, it'll cover the big bills. An example from my own life, gosh, it's 18 years now. I had a heart attack. Went in the hospital and got treated and released. I had a couple days in intensive care. And this was 18 years ago where prices were a lot lower than they are today. I left with a $200,000 bill. If I didn't have any insurance, we're talking about financial wipeout, right? Well, and again, understand this is 18 years ago. My deductible was low, my co-insurance was low. I paid $2,000 and the insurance company paid all the rest. That's what we buy major medical for the big occasions that hopefully will never happen, but at least you're not going to go bankrupt or lose your house. So that's a big advantage of major medical policies. Now, examples of major medicals, um, comprehensive coverage, all the perils, high limits like Peter's heart attack, but you have to pay deductible and co-insurance to get this policy on your claims. Here are the three examples of major medical policies that you're going to need to know on your test: HMO, PPO, and something called a POS, point of service. Now, what we want to do is just really spend some time on the HMO, which seems to be a point of emphasis on most tests, and make sure we have all the language down about an HMO. HMO is a prepaid medical service, specified medical providers. It does focus on preventive care. If you see HMO and preventive care as one of the answers, that's what they want you to pick. HMO and preventive care go together in the eyes of the state. Okay, so please connect them. Now, a little bit of history. This won't be on your exam, but it might help you to understand this. I don't know, 50, 60 years ago when HMOs were created, they were not insurance companies. What they were is doctors and hospitals came together as an organization, which is why they're called a health maintenance organization. And they said to the public, you can come to us and we will treat you at a really low price. But to do that, you have to join our organization. So you had to become a member of the HMO and pay them a monthly fee and use the doctors and hospitals of that organization. And some of the things that made them stand out is they were the first organization to pay for all preventive care without you having to pay a nickel. Preventive care is you don't have any symptoms, but it's time to get checked out. And they would check you out for free. That was one of the advantages of going in an HMO. So that's why we connect preventive care with HMO. Now, over time, it's changed and morphed. Now it's insurance companies that have HMOs, but the concept's the same. You have an organization of doctors and hospitals that will honor your membership, which another reason we don't call HMO clients insureds. We call them subscribers. You join the organization. You must use the doctors and hospitals of that organization. And they do focus on preventive care. So that's kind of an overview of where they're coming from. We'll get into some things that show up on the test. They pay the doctors on a capitated or prepaid basis. Again, for those people who already know this stuff, I'm doing the best I can driving in the middle of the road. Capita in Latin is head. That means they pay per head, whether the doctor sees you or not. So it works like this. You have a primary care doctor that you select. The insurance company will pay that doctor a certain amount of money every month because you chose them as primary care, even if you never see them. So the HMO considers that doctor has already been paid for treating you. That's why we call it prepaid. When you go to see that doctor does not submit a bill to the insurance company. He's been getting checks for you every month. So when you go in, he just treats you. They receive a flat amount every month. And then when you go in, he doesn't get an extra payment. So there's a motivation for the doctor to get you healed quickly because the more often you come back, he doesn't make any extra money. So there's a motivation built in. But that's what we call a prepaid or capitated basis. Now, for that reason, we call an HMO a service-based and not reimbursement. We're going to connect the word reimbursement to a PPO in just a few minutes, okay? But they're not a reimbursement. The member has to choose a primary care doctor so that doctor can get his monthly payment. Okay. You cannot go and see a referral. You cannot go to see a specialist unless your primary care doctor refers you to that specialist. So we call the primary care doctor a gatekeeper. The thinking is the primary care doctor looks at all of you. So I go to the doctor and I say, I want to go see a skin doctor because I got this junk over here. He said, yes, that's a good idea, but I don't like what I'm hearing in your heart. So first, I want you to go to a cardiologist. So they're there to kind of prioritize where you should start. Then you can go to the referral they give you to the specialist, who's also a member of the organization, right? Now, that means you've got to stay in the network, except for emergencies. A trick question would be HMOs never pay out of network expenses. That's not true. If you have an emergency, if you have to go to the emergency room, you got burns and they take you to the closest hospital, you will be covered for emergencies out of network. But that's the only time. If you on your own decide to have surgery with this guy who's not in a network, you will pay for that on your own because you personally selected that. Emergencies are covered. All right. Now, terms you've got to know about HMOs. Primary care physician can also be called a gatekeeper. A capitated payment, which is a prepayment. The doctor gets a check every month for everyone that picked him or her. The third one, which is not mentioned very often, but it's true, could be on the test, is you must live in the service area of the HMO to get their policy. If you don't live in the service area, they can't accept you as a client. To the extreme, I had a man once who wanted to go to an HMO that he studied and he liked it, but he lived 1 mile outside that county. It was only for one county. His doctor, his hospital were in the service area, but his residence wasn't. He got declined. He had to live in the service area to get the policy. So they're very strict on that. If you're in the service area and you have an HMO and you move, they'll write you a letter and say, now you have to select another insurance because we can only cover people who live in the service area. Now, guys, I'm quickly going through a lot of things. For some of you, this may be boring and old stuff, but other of you may be saying he's going too fast. I'm doing the best I can, okay? Two terms that show up on the test that I'm going to mention to you, and then you will never miss them, is the difference between an open panel and a closed panel. If a doctor signs up to be in the HMO and it's open panel, that doctor is allowed to see patients who are not members of that HMO. In other words, that doctor could take PPO customers by joining that PPO network, and he could see both people, get paid capitated basis from the HMO and reimbursement on the PPO, which I haven't told you about yet. They can see members and non-members. Now, there's another contract that physicians and physicians mostly can sign that's closed panel. In a closed panel, by contract, they cannot see anyone who's not a member of the HMO. They cannot treat, people who are not members of the HMO by contract. That's the difference between an open panel and a closed panel. So my best friend's son-in-law is a dentist in the state of Washington, and he's employed by an HMO, closed panel. He cannot work on his father-in-law's teeth because he's not a member of the HMO. If he does, he can lose his job. It's closed panel. That's a difference between the two. That's all I got on an HMO. We got to start with our plans by understanding the HMO. The rest of the plans, the way we teach a PPO is how's it different from an HMO? Okay. And here's some differences. They get paid on reimbursement, no prepayment. Your PPO doctors and hospitals get no money from the insurance company until they treat you. When they treat you, they send the bill to the insurance company and they get reimbursed. So remember this for the test. Reimbursement goes with a PPO. HMO doctors do not get reimbursed, they get prepaid. That's a big difference. So it's not a prepayment, it's not, you don't join the club. The PPOs sign up independent hospitals and physicians. They would go to them and say, or the physician would come to say, hey, I want to join your network. What's the advantage to the physician? Their name goes in the directory for that insurance company. It's like free advertising. Everyone who buys that insurance is going to see their name. Okay. So that's an advantage to joining the network. To get into the network, all you need to do is agree to accept what the insurance company pays you as full payment. In other words, you don't go and ask for extra money from the clients. So if you're willing to do that, they'll put you in a network and you get your name out to lots and lots of people. That's the PPO system. And it is not, I don't know why we put in fee for service. Well, I guess you provide the service and you get the fee, but the word I want you to connect to it is reimbursement. The PPO people get reimbursed. Services are provided in and out of network. Do you remember on the HMO, if you go out of network on your own, you're not covered? The PPO will cover you out of network, only they pay a smaller percentage. So you have to pay a little more out of pocket, but you can go to doctors not in the network. You don't need a referral to go to, this is incorrect, to go to a specialist. No referral from a PCP. Generally, the PPO will have more doctors and more hospitals for you to choose from than an HMO. They're bigger networks because there's less restrictions on the doctors and hospitals, and they enjoy that freedom, I think. So here is, I cannot send you our slides. However, I can't stop you from screenshotting them. This is the one to screenshot. How do I remember the differences between an HMO and a PPO? HMO, the physician's on salary or prepaid. Primary care refers to a specialist, and preventive care goes with HMO. In a PPO, they have independent providers contracting with the PPO, fee for service or reimbursement. No referrals needed to go to a specialist, and they cover you in and out of network. Folks, if you get that locked in your brain, you can probably pick off most of the questions about HMOs and PPOs, which, let's tell the truth, those are the biggest policies on medical plans. Point of service, not very often asked, but it is asked occasionally. Point of service is a hybrid. It's a combo of HMO and PPO. Think of it as this. It's an HMO that allows you to go out of network. I mean, it looks and smells like an HMO, primary care doctor, prepaid, etc. But in a point of service, if you go out of network, there will be some coverage. So it's kind of a mixture of the two. Not a lot of questions on point of service. Just remember it as a hybrid. Okay. Now, everybody who sells insurance of any kind had better understand what a deductible is. A deductible must be paid by the insured before the insurance kicks in and pays. You've all heard you have to meet your deductible. Whether you have dental insurance, car insurance, if you have damage to your car, you have a deductible there, right? Whether you sell, so if you're in medical insurance, you have an annual deductible which must be met before the insurance comes in with their money. So remember Peter's heart attack? I don't remember what my deductible was, ridiculously small, like $500. So the first $500 of that bill was on me. Then I had to pay 20% for a while. The deductible is always expressed as a flat amount. It's never a percentage. Deductible is so many dollars. That's your deductible. The deductible is followed by coinsurance. I explained to you. You must pay a percentage after you meet your deductible. The most common is 20%. The insurance company pays 80, you pay 20. It can be different. You could buy a 70-30 plan, a 90-10 plan, but after the deductible, you still have to pay something. Maggie, I passed my Texas Life and Health yesterday, thanks to you and Melissa. Thank you. That is unpaid advertising. Maggie did not receive a check from us, but she found our teaching great. Maggie, I'm so happy. That's why we do the work, is to get people through the test. So thank you for coming on and just telling me that. I really, really appreciate it. Now, I want to talk to you about something called a stop loss. It's very, very important. Remember, you got to pay 20%. For how long? If I had to pay 20% of my $200,000 bill, that is 40 grand. My friends, I don't know if you think I'm rich or not. I am not, but I don't have 40 grand in the cookie jar. Okay. That would have been devastating. My policy and all policies have a stop loss. In other words, what they're saying is that 20% that you're paying has a stop. At some point, it stops, and the insurance company pays 100% after that. How much is your stop loss? It's listed in the policy. So you could have let's bring it to current, $2,000 deductible, 80-20, the 20% goes on for another 5,000. So once you spend your deductible plus the 5, you don't pay anything else. There's a stop loss. Now, I'm not happy about a $7,000 bill for you, but that doesn't happen every year. That's the bad year when something horrible happens to you. And what you know is that's the worst that you will have to pay out in your horrible year, which could happen once in a lifetime, right? So the stop loss allows the 20% to end. That's what stops the loss for the client. All right. Now, example, the policy has a $2,500 deductible, 80-20, with a stop loss of 5,000. Our client has a $50,000 bill. This is a typical test question. Do not worry about math. They're not, if you get a question like this, you'll get one. Okay, it's not a math test. But they do want to know if you understand how deductible, coinsurance, and stop loss works. So let's take a look at this. You pay $2,500. That means you now have to pay 20% of $47,500. It's not bad, difficult math. You take the 2 and multiply it times 47. That means you got a $9,500 coinsurance bill, but you don't, because the stop loss is 5,000. So in this example, our client would have to pay $7,500. Let me go back here. How confusing is that? Take the deductible first, apply the 20%, stop at the stop loss. That's how the policies work. Are you going to get a lot of these questions? No. But I want you to understand deductible and coinsurance, that the one you get, you can find the right answer. Now, that means that this client at a $50,000 bill would pay $7,500. So, question to you folks, fine class. What if the bill was $100,000? Same answer. You pay your deductible, you pay 20% to 5,000. If that bill was 100 or 200,000, 7,500 is it. That's the limit you pay on covered expenses. Do you hear my English? Covered expenses. If there's something in there the insurance company doesn't pay, like bridge work on your teeth, um, then you have to pay for that through dental insurance or whatever. But on the covered expenses, 7,500 is the so stop loss literally stops the financial loss for the insured. Now, there's another phrase, which is the only phrase we use these days since the Affordable Care Act, but you could get either on the test. They accomplish the same goal in that they limit what you have to pay when you get big bills. The difference is with a maximum out of pocket, affectionately called by insurance agents MOOP. What goes into the MOOP is your deductible, your coinsurance, but there's another one, all your copays. So, in other words, MOOP is what you spent out of your pocket total. Once you hit MOOP, you don't pay anything for the rest of the year. Stop loss refers to stopping to 20%. MOOP is it stops everything. Once you hit maximum out of pocket, all your doctor visits are free. Any treatments you need are free for the rest of the year. If you've got prescriptions on your policy, and most do, they would also be free after you hit maximum out of pocket. All those copays you paid to the doctors and the prescriptions get included in the MOOP. Let me stop for a second. How confusing have I made that? Is that okay? Stop loss, maximum out of pocket. I don't know any test that asks you to compare them or tell you what I told you. I just want to know whether they use maximum out of pocket or stop loss. Their goal is the same, to stop what you have to pay at some point in the policy. Okay? That's their goal. So, the importance of maximum out of pocket is my client can see on the policy the most covered medical bills will cost for the year. That's all your bills, doctor visits, prescriptions, everything. If you have a maximum out of pocket of $8,000, that's the most you can spend on medical bills that are covered on that policy in a year, the absolute most. And hopefully in your lifetime, that'll never happen. But if it does, it might happen once. You know, usually people don't have those horrible things happen to them over and over. But that's what it is. That's what maximum out of pocket does. Other terms we have to know. You've got to know the difference between a benefit schedule and what we call business a UCR, usual, customary, and reasonable. There are some policies, you may not even be familiar with them, but there are some policies work off a benefit schedule. They will just list in the policy what they will pay for different procedures, doctor visits, lab work, um, you know, outpatient surgeries on your knees, but they'll list all the medical procedures and they'll tell you what they will pay. And they will pay that to anyone who's got a license, obviously not your uncle, but they'll pay that to a licensed medical provider. There's no network. You have that. This is what we'll pay. That's all we'll pay. So that might make your doctor happy. And your doctor might say, thanks for the money, but I charge $100 more, in which case you'd have to pay that. So benefit schedule, list what the insurance company will pay for the whole state, same amount. Some companies use, I would say most companies use usual, customary, and reasonable, where the insurance pays by a geographic area. I've got that in yellow because that's what the question will say, geographic area. Geographic area goes with UCR. What we mean by that is the amount we pay in this county and that county and that county could be different by geographical area. Sometimes insurance companies do it by counties, sometimes they do it by zip codes. But some areas are more expensive than others, so they'll pay more in those areas. The difference you need to know is the difference between benefit schedule, which is the whole state on one schedule, and UCR is UCR makes changes depending on where you're treated by a geographical area. And you'll get a question on the difference in those two terms. Time for a commercial. Imagine some hot dogs come out and they're dancing and singing, and you're laughing and you're entertained, and they got a really cute little tune. Go on YouTube, Insurance Exam Queen, click on join. You will get all my life and health classes for like $25. And that is the deal. Commercial done. Utilization management. You will have somewhere on your test at least one question about a prospective, concurrent, or retrospective review. We're going to review how your treatment went. Prospective is before treatment. So if you want to make a note, prospective would be like getting approval before the surgery from the insurance company, the doctor, and the hospital. Getting that all cleared before the surgery, that would be a prospective review. Concurrent review is during treatment. Now, I must confess to you, the example they give here, I have a hard time explaining it. But anyways, this is what's in the text. They list as a concurrent review second opinions. Now, in my little pea brain, low IQ, a second opinion would be done before, but second opinion goes into concurrent review. And frankly, it's the only example I've ever seen about concurrent review. Retrospective is simple. After you've been treated, did it work or not? Okay. Do we have to redo the surgery? So we're going to review before, during, and after. What you need to know is the words. Prospective is before, concurrent is second opinion, during, retrospective is after. So those words will show up on the test. Should be easy for you to cop that one. Now, networks. We talked about PPOs and HMOs have networks of providers and doctors. The cost of your policy can be manipulated by the insurance company by the size of the networks. What's that mean, Peter? Well, I mean, the large health insurance companies offer the same plan with different networks. Because if you take the least expensive policy, you will find it has relatively few doctors and hospitals that accept the plan. So if you're willing to accept a smaller choice of doctors and hospitals, you won't have to pay much. We'll call that a narrow network. Okay. And then they'll have one gold plan where, geez, they got tons of doctors and hospitals on here. And that's great, costs more. Broader networks cost more than narrow networks. Makes sense. Another war story. The young lady who was cutting my hair wanted to felt she had to have medical insurance. She did. But what she did is she bought the least expensive policy she could see. She didn't make a lot of money, right? So, hey, I got insurance. And that was great until she had to see a doctor. Then she goes on the list and she called me up to complain about this. And I told her, hey, I told you, you get what you pay for. The closest primary care doctor for her, I think she wanted to go to an OBGYN, but what doesn't matter, was a 40-mile drive. And when she got there, the office was in an area that she would not go in that office. So she had to go back, call the insurance company, and see if she could get a different primary care who was also far away. So that's the burden of a possible burden of a narrow network. So I'm not trying to scare anybody. I'm just trying to say that, insurance is like everything else. You do get what you pay for. There's a reason why some plans cost more than other plans, and it's not just this insurance company's a ripoff and the other one's a good buy. Usually you got to look at the parts to see where the difference is. Please be familiar with a health savings account, guaranteed to be on your test. We're going to talk about this and we're going to talk about a flexible spending account. When you have two accounts that got tax favorability and there's a good chance you can get them mixed up, my personal recommendation to you is create two separate sheets of paper. Have a sheet of paper just for health savings and another one just for flexible spending. There's similarities and differences. Let's first start with health savings. A health savings account is not insurance. A health savings account is really just a checking account, but it is a special checking account that the IRA has blessed and says any money you put in this account, you will not have to pay taxes on. Wow. So if I put $100 in, I lower my income by $100 because I put it in that checking account. Now, to get that checking account, though, you must have for your insurance a high deductible health plan. What that is a health plan with a high deductible, but it's more than, oh, my plan has a $3,000 deductible. That's pretty high. Okay. To be an HSA approved insurance plan, that plan, you pay everything until you hit your deductible. In other words, in common sense, you don't go to the doctor for 20 bucks. You don't get a prescription for 10. You pay full price until you hit your deductible. And because you're willing to pay the first $3,000, IRS says, okay, now if you want, you can open this checking account. And the HSA account, every dollar you put in is untaxed. As long as you use that account to pay medical bills, there will be no tax. Okay. The Control Alt Geek finally passed my P&C exam. I want to thank you guys for helping me achieve by watching your videos and giving good examples and real life stories. Cha-ching. Very good. Congratulations. Take all the credit yourself. You're the one who studied and passed. So let me get back to this health savings account. You must use the money for medical bills or there will be penalties. Okay. It's only for paying medical bills. There's a list that it's actually pretty generous. For example, you can go to marriage counseling and that's approved as a medical bill. But obviously, going to buy tires is not. So let's talk about that a little bit. If you use it for non medical expenses, I take out $1,000 to go buy tires. You're going to have to pay income tax on that $1,000 because you haven't paid income tax yet, plus 20% penalty. If you care about money, take a deep breath. If I'm in a 20% income tax bracket, I'm only going to end up with $600. I will have taken 1,000 out, but I only have 600 spendable dollars after I get done paying the income tax and the penalty. Those will be the most expensive tires you've ever bought. So you want to make sure you use the account just for medical expenses. Now, the beauty of the health savings account is your account carries over to the next year. So if I put a couple $1,000s in there, but I just don't have any medical bills this year, December 31st comes and I got $1,700 in my account. That stays in my account into the next year where I can now deposit more money. You can carry the money forward. Okay. So that's really, really important part of an HSA. The other thing about an HSA is they give you a little debit card that is, it keeps you from making dumb mistakes. I go to the drugstore, pick up my prescription, pay for it with my HSA. On the way out of the drugstore, there's a bag of jelly beans with my name on it, right? You ever had that happen to you? So without thinking, I grab it, I go and I hand the HSA card to them. Declined. Jelly beans have a code and it ain't medical. Okay. So they kind of help us out, but you don't want to use the money for non-medical expenses. It's too costly, but you can move it into the next year and move it and move it and move it. It's always your account. Let's imagine the next year your employer doesn't offer a high deductible health plan and you have to go on, say, an HMO, now I can't put any more money in the account because I don't have the insurance, but the account's still mine and I can still use it to pay medical bills. Okay. The account belongs to me, not my employer. Lengthy, a lot of talking. Hope it helps. Now, here's another test question. If you have money in that HSA account and you're 65 years old or older, you now can take that money out and only pay taxes, not a penalty. So it kind of resembles an IRA now. You got to pay taxes as it comes out, but you don't get hit with the 20%. So it kind of can be like a supplementary retirement, if you want to think about it that way. But also, if you use it to pay medical bills when you're over 65, no taxes at all. That's the beauty and joys of the health savings account. Now, it's important that we got this other thing called an FSA, a flexible savings account, that we understand the differences. So get your crayons out, make your notes. FSA is not anything you can buy on your own. You can buy an HSA on your own. You just go buy the right insurance policy and open the checking account. Flexible savings account must be offered by an employer. The employer sets how much you can have come out of your paycheck to go into the flexible savings account. So you don't get to choose that. They set the maximum amount. You can put in less. It's tax deductible. That's a D at the end of the, it's not, it depends what you describe as fund. Tax deductible fund. Medical or childcare expenses can be paid from a flexible savings account without being taxed. You have the money come out of your checking account, out of your paycheck, deposit it into this flexible savings account, and you can use that to pay medical bills or child care. However, at December 31st, if there's any money left in the account, you lose it. The money goes to your employer. So you got to make sure when you sign up for this that you're going to spend that money on either childcare or medical expenses in that year. Otherwise, you lose your money. So you can see differences between that and the health savings account. Here's the, I'll take myself out of the picture in a second. What's the difference between health savings account and flexible savings account on one slide? HSA carries over, the FSA does not, meaning you got to spend all your money by December 31st on an FSA. The HSA can be set by your employer or the individual. You can buy it on your own. An FSA must be set up by the employer. FSA allows child care payments. HSA does not. The limit of what you can put into your account of an HSA is set by the government. The limit you can put into your FSA is set by the employer. Folks, that's it. Somehow or another, if you can get those separated, you're going to get questions. Probably more on HSA than FSA, but you're going to get some questions. And my goal here is I would really love it if you get 3 questions or 4 questions on these accounts, that you get all of them in your bank. That 4 right answers toward my passing grade. So I really want you to do your best to understand the difference. Let's talk about group insurance. Group insurance. If it's a contributory group, you got to get the language down, right? That means the employees have to pay to be on the plan, pay something. 75% of the employees have to be on the insurance. 75%. The reason being, the insurance company doesn't want a plan where they only insure the sick people. At 75%, that's fine. That's 75% of eligible employees. So that wouldn't include part-timers or seasonal employees, but people who could join the insurance, 3/4 of them have to join to have a plan. If it's non-contributory, 100% of the eligibles get the plan because it's free to them. The most common non-contributory plan is some financial institutions, insurance companies, banks provide life insurance for the employees at no cost to the employee. So that means you're going to be insured whether you want it or not, because it's 100% non-contributory. So get clear on the words and how that works. Group insurance, easy question to get. Only one policy in group insurance. It's called the master policy, and that's provided to the sponsor, usually the employer. Only one policy. So what do the insureds, the workers get? They get certificates that say you're covered under policy number XY 1200, whatever. Okay. And here's what you're covered for. But it's not a policy, it's a certificate. Who can buy group insurance? So we got three people here: Employers Association and something called METs and MUAs. Now, employer sponsored is the most common. Some things you got to know about an employer sponsored plan. Number one, the employer sponsors it. That goes without saying. It's not that the employees buy it, the employer does. It's group underwriting. That is code for saying they don't ask health questions of the employees. They understand they're going to get some sick people and some healthy people. They let the law of large numbers play that out because they know this: they're at least healthy enough to go to work. Okay. And they get the rate. How they get the rate, since they don't have any health, is the age of the group, the size of the group. The younger, the better, the larger, the better, more people. We got the law of large numbers, right? And if there's a claims history they can get on what claims have been paid on the group. But basically, that's how they rate it because they're not going to get any health information. Participation level, we've already talked about, 75 or 100%. If a group is 20 employees or more, they must offer COBRA to any employee who leaves the group. So it's COBRA eligible. Group insurance. When somebody leaves it, they can convert or they can take COBRA. Conversion is you take and get an individual policy from the same insurance company. You have 31 days to choose that. If you choose that, you now have your own policy, which you can keep as long as you want. And your deductibles and everything start over again because it's a brand new plan. If you instead decide to take COBRA, you're actually going to stay on that employer's plan, and you have 60 days to decide to do that. COBRA's got limitations, okay, but you can stay on the same plans. For example, if you leave in June and you've already met your deductible, staying on the plan means you won't have any more deductible in that year. There's other things about COBRA which are explained, could be on the test. You can only keep it for 18 months. You got 60 days to sign up. And you probably ought to get familiar with those particulars. But that's what happens if you leave a group plan and you want to continue insurance, either conversion or COBRA, if it's a COBRA eligible group. Different states have different laws, but the federal law is 20 employees or more must offer COBRA. Now, what about the associations? Association has to have 100 people, unless you live in Arizona where it's only 25. The association has to have been active for 2 years and hold annual meetings. So what are we talking about, Peter? Let's just imagine a homeowners association. If they have 100 lives, they've been active for 2 years, they hold meetings, they can go and buy group insurance for their members. That's all that means. If you get a question on association, remember the 100, unless you're in Arizona. Okay, so that's all I'm going to say about that. Now, a MET can buy group insurance. there's hardly ever questions on the MET, but anyways, it's a multiple employer trust. What happens is employee employers of a similar business, imagine air conditioning companies, go together and they form a trust. They have a trust written up and they call it the air conditioning trust or whatever. The trust buys the group insurance, which is eligible to all the employees of all the companies. The thinking here is if I can get more employees on the plan, it might lower my rates. Okay. So you can do that. You can set up a multiple employer trust and have the trust buy the insurance. Okay. And that's called, you can get a multiple employer trust can it get a group policy. The other one, employers of similar industries form the multiple employer trust. The trust purchases the insurance. What am I doing? Going backwards? Yeah, I am. MUA, Multiple Employer Welfare Association, not frequently asked at all because insurance departments don't like these plans. It can be offered for 2 employees or less. And here's the part that freaks out the insurance commissioners. It's usually self-insured. What does that mean? The employer doesn't buy insurance, but the employer pays the claims of their employees. Well, that could work if you don't have many claims or your claims are reasonable. What happens if you get a couple of guys have the Peter heart attack? Does that employer have $400,000 to pay that? And that's what concerns insurance departments. They don't like them, but they're legal. Don't worry about it. There's not many questions on it. Just remember 2 employees, usually self-insured. Let's talk about the Affordable Care Act. There are not many questions on the state exams on the Affordable Care Act. So I'm going to talk about the most common things the Affordable Care Act did. Number one, they guaranteed issue. If you buy a plan from, and by the way, a lot of people don't know this, Affordable Care Act is not insurance policies. Affordable Care Act is a law that says you buy policies from an insurance company, and if they are Affordable Care Act approved, these are the laws they must follow. Guaranteed issue means you cannot be declined. I don't care if you're stage 4 cancer running up huge medical bills, you apply for it, you get the policy. And number 2, they cover all pre-existing conditions. They're going to cover that cancer. So those 2 for the clients are beautiful. Oh, I got to get insurance, but Peter, I've got these medical problems. Don't worry about it. Affordable Care Act, you apply for it, you get it, and all those medical problems are covered. No limit on coverage, not discussed very often, but for essential benefits. If you have large bills, you can't run out of insurance. Oh, but I'm a paraplegic and it costs $1 million a year to keep me going. They'll keep paying it. They won't say, you only had $5 million of coverage and now you're not coverage. No limit on coverage. There are 10 essential benefits in Affordable Care Act plans. That's really, if you get a question, that's the answer. There's 10. Who can get it? You have to be a citizen or legally present. You have to live here. So if you're a citizen, but you're residing in France, you can't get it. You can't be in prison and you can't be on Medicare. It's pretty simple. If you meet those criteria, you can buy an Affordable Care Act plan. We buy plans in metal, metal, bronze, silver, gold, and platinum. Platinum's the best. Bronze is the least expensive, covers the least. And the percentages applied are 90, 80, 70, 60. That's not a co-insurance percentage. There's this complicated formula the insurance companies have to run bills through. And if they cover 90% of the bills, they're a platinum plan. If they cover 80, they're gold and whatever. But when you shop, you can see bronze plan will cover the least and be the least expensive. So that's how we buy these plans now. There are, as I told you, 10 essential benefits. Believe it or not, that's a test question. How much easier can it get? 10 is the number of fingers on Peter's hand today. There's 10. Do you need to know all 10? No, you don't. I mean, most of them, doctors, hospitals, ambulances, labs, outpatient surgery, stuff you'd want covered. Prescriptions, okay? But the two that were new when the plan passed is maternity is covered on every plan, as is mental health. So just to stretch that out, all people, including men, all people, regardless of age, are going to pay a maternity premium. Okay? Maternity and mental health are in every single plan. What is it with my slides that keep going in the wrong direction? Now, folks, I really covered the heart and soul of the medical plans chapter, but I have neglected two important policies because they are in their own chapter. Disability income is usually a chapter into its own, and there's specifics about that. I usually teach disability income alone. A long-term care insurance policy is usually built into the senior products chapter because it's pretty much a product that's desired most by seniors. But those I did not cover today. The rest of the stuff I covered, hopefully, I organized it in a way that was helpful to you and prepares you to pass the test. So let me just see if I do have another slide. I don't think I do. Oh, another commercial. Insurance Exam Clean, join, get all my teachings. My teachings, by the way, are not brief like this. I might go a couple of hours on each topic to cover everything in more detail. But the thing is, it's recorded, so you can listen to what you want to listen to. Final slide from Melissa herself. Stay calm. Study the materials, not questions. In other words, don't prepare for a test by only taking practice exams. You got to understand the material. Use all the tools that we have available to you, and you'll pass the test. The one that's not on here that I'm going to tell you, please study every day. Okay? Even if you only got 15 minutes, pick up the books and at least go over something. Keep your mind focused on the material as best you can. So I want to thank all of you for coming. I had a good time. Whether you had a good time or not, it's up to you, but I hope it was helpful. If anybody's got a question that I messed you up on some of this stuff or you need further explanation, I don't mind hanging around a little bit to answer those. But for those of you who've got to go, thanks for coming and come back and see us again. I haven't posted my live classes for next week, yes, but you can always go on there. Probably today I'll get next week's classes all scheduled and you see what I'm going to cover. But anybody got questions for me before I take off? Well, I thank you for coming. Stay healthy, study. Let's get this test passed. Thanks for your attendance. See you soon.